Over $1 trillion in AI market value was erased during the recent sell-off. People are officially calling it a reality check for the AI bubble. Look at incredibly popular companies like AMD. They lost roughly 11% of their value in a single session. That translates to tens of billions of dollars in market capitalization completely wiped out. If investors buy at the absolute top, then they experience massive portfolio drops. It might seem like a standard correction, but the overall scale is catastrophic. This represents hundreds of billions of dollars of paper wealth disappearing from investor portfolios. This is not just random numbers moving on a digital screen. This represents massive equity contraction across the entire financial system. I want to show you exactly what is actually happening behind the scenes. There is the fake story they want you to believe, and then there is the brutal reality. I am going to explain how this machine works so you do not get crushed. Level 1 is the great reality check. The story they are forcing you to believe right now is that AI is just recalibrating. A while back, the CEO of OpenAI predicted an absolute job apocalypse. He stated that entire job categories would be totally gone. He claimed AI would completely evaporate things like law firms and accounting firms. Now he is suddenly changing his tune at a major banking conference. He recently said that he was pretty wrong about those economic impacts. He admitted he is delighted that a jobs apocalypse will probably not happen. So what exactly caused this sudden shift in corporate perspective? I use Gemini and Claude every single day. I can tell you for an absolute fact that they are highly capable. But they also tend to make a lot of massive mistakes. There is absolutely no conscious understanding behind these language models. If there is no human oversight, then these errors can cost companies millions. If you run a huge law firm, then you cannot just delegate everything to AI. That one single hallucination could literally bankrupt your entire operation. You still need a real human being to double verify every single document. Enterprise companies are realizing that automation requires massive human verification teams. If you cannot remove the human element, then the expected cost savings disappear. Here is what immature investors completely misunderstand about the stock market. Level 2 is the valuation trap. Stock prices today are based on discounted future cash flows. When institutional analysts value a company, they estimate earnings decades into the future. They take those future trillions and discount them back to today's net value. If a business is projected to grow exponentially, then the stock price skyrockets today. They price the asset for absolute perfection. But what happens in the next quarter if that future forecast is not raised? The biggest misconception is that investors are betting on AI technology itself. They are not betting on the technology. They are betting strictly on accelerating growth rates. The moment growth stops accelerating, the entire valuation model changes completely. If a company does not promise even higher acceleration, then funds begin revaluing their positions. Take Broadcom, for example. They are one of the most profitable infrastructure companies on earth right now. In their second quarter, they generated $22.19 billion. Wall Street expected them to hit $22.13 billion. They beat the revenue expectations and reported record free cash flow of $6.4 billion. In a normal market, their stock should have skyrocketed on that news. But instead, Broadcom lost roughly 14% of its valuation after the call. They did not raise their full-year AI chip forecast past $100 billion. Because they kept the guidance steady, instead of increasing it, large institutional investors reduced exposure. Level 3 is the supply chain domino effect. The entire AI industry is just one massive interconnected supply chain. Broadcom designs highly advanced chips and then sends them to TSMC for manufacturing. If Broadcom does not accelerate its forecast, then expectations drop for TSMC. If TSMC makes fewer chips, then that impacts everyone else down the line. If chip production slows, then Amazon and Microsoft and Google get less hardware. If they get less hardware, then they will build fewer data centers. If data center growth slows down, then capital expenditure across tech fields collapses. Suddenly, cloud infrastructure platforms will be growing at a much slower pace. The entire industry will bring in far less revenue than Wall Street modeled. Building real physical technology takes a massive amount of time. You cannot just construct giant data centers overnight. You have to design the silicon and build the power grids and secure clients. But the stock market moves purely on shifting forward-looking perceptions, and the stock market prices adjust instantly overnight. A sector can lose trillions of dollars of value in a single week. There is a real technological revolution happening on the engineering side, but the financial pricing side has detached heavily from underlying fundamentals. It has turned into an aggressive game of musical chairs, and unprepared portfolios are the ones left holding the bag. Level 4 is how you actually survive this crash. The first group of market participants are the speculative investors. They do not look at underlying balance sheets or valuation multiples. They see a stock price moving up and buy purely out of momentum. If you buy blindly based on momentum, then you buy at the peak. If the future growth forecasts flatten out, then institutional funds dump shares. The people who bought the peak hype become the ultimate exit liquidity. But if you calculate true historical valuations, then you avoid the trap. You must evaluate companies based on cold, hard mathematical metrics. Look at Oracle as the perfect, factual example of this exact mechanism. In early 2026, the stock was trading at a low of around $136. The intense AI narrative previously pushed the price to an all-time high of nearly $346. At that peak, Oracle's price-to-earnings ratio expanded far beyond its historical average. The multiple expanded drastically, despite growth rates that had not increased enough to justify it. When quarterly growth metrics failed to justify that extreme multiple, the market corrected. The stock plummeted rapidly and currently sits around $210. If you understand the underlying math, then you do not buy at the top. You survive the bubble by matching the stock price to actual current cash flows. Level 5 is the brutal summary. The AI revolution is a real engineering marvel, but the stock market turned it into a financial casino. Enterprise companies are realizing, I cannot replace humans without massive risks. Wall Street is punishing profitable companies just for not growing fast enough. The physical supply chain is slowing down because expectations were completely detached from reality. And normal retail investors are buying stock at the absolute peak. Do not let Wall Street use your portfolio as exit liquidity. You have to evaluate these companies based on cold, hard cash flows. When a stock price detaches from its historical earnings multiple, you must walk away. That is the only way you survive this market. Thank you for watching, and stay safe out there.